Good morning and welcome to the Prescient Investment Management Alternative Investments Update for Q3 2023. My name is Samantha Petty and today I'm joined by our Head of Credit, Conway Williams, our Credit Analyst, Michelle Green, and one of our Portfolio Managers, Luzuko Nomjana. Today we will be speaking about the importance of infrastructure investments as well as some of the key topics that have come out during this last year. So to kick us off, Conway, can you give us a brief overview of what alternative investments actually are?
Good morning, everyone. Thanks for joining us again today. So I think just to start off, when we define alternative assets, the general thinking is private equity, hedge funds, property type assets. In our case, we also include infrastructure, which is a burgeoning asset class on its own in terms of how we see it. And then very importantly, the private debt space. So all of those represent about 15% of the total assets in terms of global capitalization of assets that are out there. To put that in perspective, that's about $27 trillion worth of assets just in the alternative space. And then if I just take one step back, if you're just looking at the private debt space in terms of what we are going to be showing you today, that is about $1.6 trillion. And then just to show you how that has grown, at the end of 2015, the private debt space on its own was only $500 billion. So there's been a significant increase not only in the alternative space in terms of the definitions that I've given you, but then also in terms of the private debt space. And we've got various reasons for why that has grown. But again, the main point is that there's a need for the private sector to provide, again, capital. And again, if you're just looking at our economy on its own, our country on its own, the needs, you can understand why there's been this massive expanse or interest in the actual alternative space. It has been driven by various factors. One of that is been the changes to Regulation 28 as an example. But again, it is an asset class that is showing growth for various reasons, and it is an important asset class globally and very importantly in emerging markets.
Thanks, Conway. That's really interesting. So that's framing it quite well, but can you take us through what the risk-return characteristics of the investments are?
So the starting point is that there's this massive myth that infrastructure alternatives is this asset class that is so risky. And what we've been trying over the last 3 years since we've joined Prescient and then in our previous lives is to actually really debunk that myth. A recent report by Moody's, and I think most people have seen that report now, shows that the default risk for emerging market and specifically South African assets are actually quite low when you compare it to our global peers. And that is not only emerging market peers, but actually developed market peers. And it's significantly lower than our developed market peers, importantly. And then you want to throw onto that the actual returns that we are earning for our infrastructure assets with this lower risk profile than our developed market peers is actually better. So there's always this myth that there's this race to the bottom, that spreads are contracting. But if you're looking at it from a return per unit of risk perspective, we are actually in a very positive position, in a very strong position. And I think that is also one of the key drivers for why the asset class continues to grow. One, it meets the developmental needs of a country like South Africa. It's got a low risk for various reasons, and Luzuko will probably touch on that in a minute. But then also that return characteristics. You don't need to forego commercial returns to actually make a key positive difference across various types of initiatives, whether it's SDGs, the Sustainable Development Goals, or just normal impact that isn't even tangible or seen. Like you can really make a big difference and earn those returns.
Thanks, Conway. It's really interesting, and I think that shows that there are some real tangible benefits to this. So, Luzuko, can you show us more about what infrastructure investment is about and give us some insight into the value that brings?
Yeah, I think when you talk about infrastructure investment, right, and how that actually translates to economic growth, I think one wants to look at it in almost two strides. One as an enabler in terms of economic growth, or as an economic hub or a direct economic activity. And if you look at the mini towns, for example, that have come up as a result of mining that happens in certain locations, mining coal, mining the different resources that we have as a country. That I think that sort of helps paint a picture in terms of the economic activity or contribution of infrastructure towards economic activity. When you talk about a direct economic hub, I think you want to look at a typical example like your investment into various projects across the country. You have the Aqua Road Stone CSP project, for example, that we're involved in, that's coming up in the Northern Cape. Now, it's a renewable energy project that seeks to, when it's complete, it's going to be able to generate about 100 megawatts of electricity to the national grid. And that is really the core purpose of that project. However, you have, and that's sort of almost a direct contribution to the economy, generation of electricity. But you also have this sort of direct economic contribution towards that area, towards that economy. This project is in the Northern Cape, in Port Moresby. And we all know that the Northern Cape is one of the most economically impoverished provinces in the country. That project alone has created about 972 jobs because it's in construction, and it's going to be in construction for 3 years. Of course, that number does go down a bit when that project goes into operation. But at the moment, and for the past almost 2.5 years now, it's created about 972 jobs. That is just one aspect of it. The other aspect is that once it comes alive, and it's going to be in operation for 20 years, distributing power to Eskom for 20 years. It has to drive and contribute towards, driving SMME development in that area. You want to contribute towards SMMEs that in that area, give them funding, give them, guidance and training towards development of their own small businesses. It helps contribute towards the driving and the development of SMMEs in that area, but also just socio-economic activities. And these range from bursaries, sending kids to school, creating jobs for people in that area. I spoke earlier about 972 jobs. Most of these jobs have to belong to the people within these various communities. Early childhood development centers, and this project has to actually drive these initiatives for each of the 20-year period. Now, imagine the sort of the type of benefit and the change that a typical project like that can actually live in that community over a 20-year period. So I think that helps draw a picture in terms of exactly how investing into infrastructure actually helps towards driving economic activity.
Thanks, Luzuko. So now let's take a look at some of the key topics that we've seen come out over the past year. Alternative investments such as the Prescient Clean Energy Fund and similar funds like this have been considered integral in dealing with issues such as climate change. Can you explain this?
Yeah, and I think it's really quite clear when you look at, I think various sectors of our communities are still in denial, but I think it's becoming clear, at least over the past 2 or 3 years, where we've seen the severity, intensifying severity, but also the frequency of storms, of floods, of hail across various areas in the country, but particularly the KZN and the Wild Coast area, some parts of the Eastern Cape. If you look at South Africa as one contributor towards global climate change, of course, Africa in itself is not significant in that, but South Africa is significant within the context of Africa in terms of global emissions. And this, the energy generation is one key sector where greenhouse gas emission is quite intense. And funds like our clean energy, Prescient Clean Energy Fund help, towards reduction of this intensity in terms of energy generation. And we do this obviously through supporting projects that are low emitting. In fact, a lot of the wind farms and the solar farms that the fund is actually invested in actually did not generate any emissions for the 20-year period, 25-year period, during which they actually produce electricity. Of course, some people will argue that, where do they get the components, where do they get the solar panels, and what is done, when these solar panels have sort of reached the end of their useful lives. Fine, that's a conversation we can have. But I think for that 20-year period during, which these farms actually generate electricity, they do not generate emissions. And that is, I think, is a massive win, significant win already. Of course, we've got to do this within the South African context, which talks just energy transition. So we've got to be thoughtful about how we do it. We've got to be tactful about how we do it. But I think the fact that clean energy, the cost of clean energy, has come in cheaper in some instances, cheaper than how the cost that Eskom shows in its financial statements, the cost that they incur to produce their electricity. So that also obviously also helps because our integrated resource plan, which is our energy blueprint, talks to affordability, talks to least cost, and this energy coming in at this low cost obviously helps that conversation a lot.
Thanks, Luzuko. So, Michelle, can you maybe give us some insight into the role that funds like the Prescient Infrastructure Debt Fund and similar funds have on the context of South Africa?
Thank you, Samantha. Sure. So I think the key thing to remember is, and my colleagues have already alluded to the fact that infrastructure investments is key. There's a significant gap that we can play as a role as an institution to actually breach that gap and fund these infrastructure needs. Ultimately, it plays a pivotal role in bridging the gaps of communities, just having basic services, for example. We, as an institution, can deploy money into these projects and breach that gap. I mean, Conway wrote a piece about infrastructure gap. It's on our website. It goes into detail and it speaks about trillions of rands that is needed in order to breach that gap. And that just gives us a significant picture in terms of the need for us to grow, not only as a community, but also as an economy, because that does hinder activity within South Africa, right? So these funds not only can play that role in providing financing to these projects, but also to ensure that there is scalability. We can get the economy to grow. We can get the communities to uplift social development. Another key area is that it ultimately can provide risk mitigation. So having a team that is experienced, understands the investments, structuring it in a way that can provide investors with a vehicle or a means that is still risk mitigant, providing predictable but also stable returns that is inflation beating and uncorrelated to that of traditional equity and other capital markets. And it's been proven that over time, actually, that uncorrelated predicted returns have actually shown that these funds can outperform during volatile periods during the market. And one key event that we're all familiar with is the COVID-19 pandemic. And the Prescient Infrastructure Debt Fund, for example, has showcased that it still was able to beat the benchmark during that period of time. Now, having said that, taking all of that into account, we can play quite a pivotal role in ensuring that there is economic growth. We can have a positive impact socially, but also from an environmental perspective. Alongside that, the government has put out a national development plan. It has a 2030 goal, and we, as an institution, can play a role in order to gear money towards these initiatives that is there to reduce poverty, for example, job creation, access to basic material services, infrastructure, even social housing. I think we all can be testament to the fact that a lot of our people are living in conditions that is inhumane. And we need to look at it from a perspective is how we can invest our clients' money responsibly, but also at the same time, also help our community in a sustainable way and partner with projects that is able to do that and achieve that in the long run.
That's really inspiring. Thanks, Michelle. So given what you guys have said based off the benefits of from a developmental perspective, can you give us some more insight into the actual Prescient funds?
So I'll start. So we have two offerings from an infrastructure point of view. I'll chat briefly about the Clean Energy Fund, and Michelle will give a bit more detail in terms of the infrastructure debt fund. Clean Energy Fund has been in operation since September 2015, so about an 8-year track record now. It's currently sized about 3.8 billion, and it's invested across 28 projects located across the country, various locations across the country, predominantly invested in solar PV and wind farm, which is really I think those are our bread and butter technologies in terms of renewable energy in South Africa. And in terms of returns, the benchmark is a CPI plus 4.5% on a gross of fees basis, and I'm very happy to know that the performance of that fund has consistently outperformed that benchmark, and really do not have any reasons to believe that that's not going to change. Of course, we admit that CPI plus 4.5% benchmark is quite strong, but we believe that there's enough opportunities in South Africa, and we possess enough sufficient expertise internally to actually continue generating this alpha and continue outperforming the benchmark. So I think that's an overview of the Clean Energy Fund. It's a debt fund, open-ended debt fund. It really invests in senior debt, but all the way to your most junior debt. And I think one of the key advantages that we're able to, something that we're able to do a lot of the other players are not able to do, is actually provide debt for equity players, which is really a growing, I suppose, opportunity that has come out in terms of the REAP procurement program. You see an increasing requirement that's driven by the DMRE and the IPP office to increase ownership of PE players, and a lot of these players sort of are struggling to find sources of financing. A lot of them are already funded by most of the DFIs and are sort of approaching those concentration risks. So our ability to be able to provide that kind of funding actually puts us in a very good position to be able to be competitive. So I think in broad terms, in a broad sense, that is the Clean Energy Fund. I spoke about the Aqua Redstone project. It's just one of the 28 projects that we actually invested in. And I think one key thing about that project is that it helps us answer, I suppose, one of the key questions out against renewable energy, that it is intermittent in nature, and this project particularly is actually able to generate electricity for 12 hours after peak, which is very similar to your coal-fired power stations.
Thank you, Luzuko. So I'll take you through the Prescient Infrastructure Debt Fund. The fund was established in 2021, so it has about a 3-year track record. Currently, the size of the fund is 1.6 billion, and it's grown significantly since the launch. It's currently yielding 12.86% with a weighted average term to maturity of just shy of 4 years. The benchmark of the fund is ultimately JIBAR plus 3%, and the mandate of the infrastructure fund is ultimately to invest in infrastructure assets. What that ultimately means is we are able to invest in sectors across the board, so it has quite a broad spectrum for us to invest in. So this aligns quite nicely with the National Development Plan that we mentioned earlier, is actually to invest in areas where there are inequalities, for example, gaps, and we are able to invest into projects across the spectrum, whether it be social housing, for example, water, road, agriculture, I think, or even clean energy, renewable energy, for example. So it kind of spans across a various number of sectors, and because of that, we are able to provide our investors with diversification. So that comes back to the predictable returns that I mentioned earlier. Now, having said that, since inception, the fund has outperformed its benchmark since 2021, and that's ultimately testament to the fact that we have an experienced team that has the necessary skills, that has the experience, deploys the time, and actually does the research to understand what we're investing in, where we're investing in, and partnering along these investee companies. Now, having said that, while it should meet the infrastructure definition, we also look to at least meet one of the SDGs, that being the social development goals. So that also spans again across a number of goals, also meeting social goals from a community perspective, but also on a broader economic perspective. So this fund is able to go into, like I mentioned, from various sectors and provide our clients with returns that is inflation beating. And like I mentioned, it has outperformed since inception. So having said that, we are able to provide our clients with uncorrelated returns, predictable, stable returns during volatile markets. And we're able to not only provide that, but also have a positive impact. And that ties, or rather has an alignment of interest from a Prescient perspective. It goes to our impact ethos, is that we want to invest in companies or projects responsibly and deploy that capital so that not only we can have the return, the risk-adjusted returns, but also to have a positive impact, both on a social development perspective, but also on the broader economy.
So Luzuko, can you take us through how we as Prescient are playing our part in addressing some of the challenges that we are seeing in the infrastructure space in South Africa?
Yeah, and I think that's a very broad question. We do what we can within the ambit of our reach. And this includes staying very close and being very collaborative with organizations like ASISA, which is very close to, I think it's an organization that is very powerful in that it brings together all the asset managers across the country and really shares thoughts and ideas on how best you can invest into some of these projects, into infrastructure, but while obviously putting at the center our fiduciary duty as asset management, risk return being a part of that. So we stay very close to ASISA, we stay very close to the DFIs, and we stay very close to the banks. I think our relationships with some of the top 5 banks in the country have really gone a long way in helping us scale these funds up, see the opportunities that we really want to invest into, and allow us to be choosy in terms of exactly the opportunities that we like for specific reasons. Obviously, they have to go through investment committee as per the norm in terms of risk management. So I think that's what we continue to do, and I think it's very important to be clear that we invest into projects which we believe can stand on their own, are credible, and will be able to generate returns for as in line with the benchmark of the fund. Of course, if that particular project is able to leave a lasting legacy in terms of socio-economic benefits, we have a particular affinity for that. I'll make an example. One of the projects we invested in terms of the broad infrastructure fund, invests in fiber development, and this takes fiber across various parts of the country, including the townships. And one example that sort of came to me was, rolling out fiber into a township. Fiber is obviously a lot more stable and a lot cheaper than your typical 5G and 4G. Now, you're able to bring that into a township. Somebody stays in a shack. They actually have a job in a call center. They can actually do that job within their shack and save what they typically spend going to and from work on a daily basis. This can go up to 30%, 40% really of their income. And in some instances, that saving can be enough to actually allow them to move from a shack into a mud structure. Of course, it has to stand on its own. It has to be credible. Committee has to be happy with the risk return basis. But if it is able to do that, but also leave that kind of lasting legacy, of course, absolutely, it's well within our ambit.
So I know we've spoken quite a lot about how this impacts the communities and the greater South Africa, but what does it actually mean for our investors?
So I think that's something that we always very cognizant of. So if you think of our individual backgrounds, we're very passionate about making a developmental impact. But ultimately, making that developmental impact does have a growth sort of ambition or a positive for the country as a whole. So again, we're talking about what we can do at grassroots level to improve things. We're now taking it back to the investor itself. Why would somebody invest in Luzuko's Clean Energy Fund or the Infrastructure Debt Fund that Michelle co-manages. Importantly, during various cycles, we've seen, and Michelle said this many times before, it's that uncorrelated return profile, it's that annuity income. So people then can throw questions at us, but then you don't have liquidity, or are these instruments not marked to market, and all of those things. But every single investor out there ultimately faces a decision on how you put a portfolio together, how much liquidity you have in your portfolio, how much of these unlisted assets that you have. And there's always this trade-off between return, risk, liquidity, correlation, uncorrelated nature, and the likes. And that is what you do as an investor in terms of how you allocate it. But importantly, what we're doing, if we use it as a building block for internal funds or external investors invest in our fund, is that we actually have a team that manages these assets properly. We don't only go out there and do these deals altruistically. That's not our job. Our job is to meet client promises. And our client promise is that we will invest in good, whether it's clean and green, whether it's broader infrastructure, and still earn commercial returns. And again, I always talk about these myths, and we have to debunk all of these myths. Since 2015, the inception of the Clean Energy Fund, since 2020, we've been able to do so much good and still beat our benchmark. And a CPI plus 4.5 benchmark is quite austere. JIBAR plus 3, given the fact that margins are doing that, we've been able to beat that for the just under 3-year period that these funds have been around. So you get those type of return profiles that are good for pre and post-retirement for clients. You get low volatility through these products, and there's always going to be, as I said, those question marks about it, but we also do good. And we're debunking that myth every single day while doing things that we are really passionate about. There's always this argument about, okay, then I can buy government bonds. But is government bonds going to take Wi-Fi connectivity to rural KZN? No. And we want that to be done, yet we're earning commercial returns for it. So our clients love what we do. They trust us because we've got a significant amount of experience, not only the three of us, but our broader team. Our investment committee, which is also known as a credit committee, is significantly experienced. So we look at risk appropriately, pre-putting a deal onto book, post having a deal on book. We cradle to grave in terms of how we approach deals, approach the management of our funds and likes. So you've got a safe pair of hands, or how many, 5 pairs, 10 pairs of hands around the table, looking at these deals, and you're getting positive returns and development. What's better than that?
Thank you, Conway, Michelle, and Luzuko. And thank you all of you for joining us today. Alternative investments, and in particular infrastructure investments, are really important to focus on, not just for returns, but also for the improved quality of life for all South Africans. So we encourage you all to collaborate with us and engage with us. And so we'll now take some questions. Good morning. Thank you all for joining us, and thank you for sending through your questions. I'm going to jump straight in. So when we talk about the Redstone project, Luzuko, can you tell us why this is important for the country?
Sure. How's it, everyone? And thank you so much for joining us today. So this is a project that's actually coming up in the Northern Cape. It's about 100 megawatts. It's gonna provide about 100 megawatts of clean energy to the country, and it's been in construction for the past 3 years now. We expect that it's gonna connect to the grid in about February 2024, thereabout. And I think from a country sort of contribution point of view, community contribution point of view, and while this project is in construction, it's created about 972 jobs. And most of these jobs, majority of these jobs, go to South African citizens, go to the surrounding communities. And this obviously talks to, one of the key ethos of what these projects are actually supposed to do. Sure, provide the electricity, provide clean electricity, but also uplift the community. And, within that same breath, in addition to the jobs, these projects have an obligation that's created by through the RIP program to allow these communities to actually have an equity ownership to these projects. I'm just not sure about the actual percentage, but to the extent that they have community ownership, the community sits on the same table as the developers and some of the private equity players. In addition to that, there's enterprise development and social economic development objectives. These can go up to 2.5%, sometimes higher, of revenue per annum. This actually means that this project is going to be providing electricity to Eskom over a 20-year period. they have an obligation to actually spend a minimum of 2.5% of their annual revenue in terms of these enterprise development and social economic development initiatives. This can actually leave, a significant positive improvement in terms of the community in which these projects are. I did highlight in the presentation that one of the key, I think, differentiators of this project, of this technology being a concentrated solar power, is that it can actually provide electricity for up to 12 hours off peak. And that's obviously quite important in a country where we're looking at transitioning maybe out of some of our older power stations, which are actually providing that base energy. Now, this technology allows us to actually replace some of that base energy, which is actually quite cool.
Thanks, Luzuko. So, Michelle, I think this is one for you. Are these funds considered ESG funds?
Thank you, Samantha, and thank you, everyone. So these funds isn't necessarily considered ESG funds, but rather think of it as a socially responsible vehicle and access to infrastructure, which happens to be, clean energy, but also a broader spectrum. My colleague Conway has already touched on the fact that our fiduciary duty is to preserve capital, but also to ensure that we do have the risk-adjusted returns. And these two funds actually provides investors with a channel to access this, but also off the back of that, there is impact. It's economic impact, but also shows social development. So not necessarily ESG centric funds, but off the back of that, we do take into account ESG as part of our risk assessment tool. So if you think about these funds, think of it more of a socially responsible lens instead of an ESG focused lens.
Cool, thank you very much. With all of these efforts to debunk myths, have you seen a change in investors' attitudes towards investments in infrastructure?
That's a very interesting one, and I think we actually have seen phenomenal growth in alternative assets, and importantly, in terms of renewable impact or socially responsible type investments. So just to paint the picture, if you're going back to 2003, the alternative asset space accounted for about 2.3 trillion. As at today, it is $27.7 trillion.
Yeah.
So just think of the sheer size on an absolute basis, and in that real trajectory of growth, it's becoming a larger percentage of the total asset base globally. So that phenomenal growth is evident in the numbers. And again, we always show numbers first. Then we just try to dissect why it is that growth is actually coming through, right? And again, there's climate transition. It's national imperatives to make sure that the fiscus actually provides roads, hospitals, renewable energy, sustainable energy. So there's a lot of things that are happening to make that's actually pushing the alternative space, and importantly, the infrastructure space, that growth. And that is why, even if we just look at the interest in our funds specifically, we're seeing more and more players, institutional, retail players asking us a bit more about our space, noting that we're making such a significant developmental impact, yet we're not foregoing returns. Then asking questions like liquidity, how they can change from this type of asset to that type of asset class, or the one that we're helping manage. So again, the data shows that there has been phenomenal growth, the interest in our funds, the actual fundraising that we've actually been able to achieve over the last 3 years, and then importantly, the deployment. Like Luzuko can probably talk about our pipeline. We can probably invest in about another 4 billion rands worth of assets. And that is just our 18-month pipeline on its own. So again, a lot of interest in the fund, a lot of it's out there. Combine the two, and you get that commercial returns with that developmental impact, like Michelle mentioned.
That's really interesting. Thank you. Okay, last one that's come through. Can you give some more information on the project that is taking internet to the rural areas of South Africa?
I'll take that one. Thank you. So this specific project is headed up by a company called Eagle Towers, and ultimately they are responsible, or their aim is to construct, operate, and maintain telecommunications towers South Africa, and specifically covering the rural areas. And part of their mission is ultimately to bring these rural areas, the community, closer to connectivity. And that's specifically, if you think about it, approximately 32% of the South African population actually lives within these rural areas and do not have the access to mobile connectivity that is ultimately essential for the growth of not only the economy, but also from a social development aspect. So you think these kids, for example, have to walk kilometers upon kilometers in order to find a facility that doesn't have necessarily the appropriate or, the strongest of connectivity, but this helps them obviously to grow and get through school. So the aim of this company specifically is to bridge that gap, ultimately, that digital divide that if you think about it, and ultimately so they can have access to this information, make it easier and provide these services to the communities. And so the reason why Prescient has partnered with Eagle Towers is specifically because of this initiative, or rather the mission, to bring about not only the social aspect, but also provide them with money to expand this further. So we've entered into a senior debt facility of 100 million, and ultimately that is across a number of years where they'll go into these communities and expand. And this fits very nicely in terms of our impact ethos. It speaks to us investing this money responsibly, but also at the same time getting our clients the risk-adjusted returns, but at the same time having that impact in the communities and the broader economy.
And I think just to add to that, right, before a tower is put up as an example, there's an impact assessment that needs to be done in terms of why people would need connectivity in a specific region. Mm-hmm. We don't want to provide connectivity so people can be on YouTube, right? Even though there are, I suppose, positives of that. It's actually for whether it's going to be for job creation, people being able to work from home, schooling and the likes. And then we do a post-assessment as well if that's actually been the case. And we're seeing that sort of positives that are coming through. Another thing is with these funds, we don't only want to be investing in regions like the Western Cape or the North. We want to be investing across Africa. I'm not across Africa, apologies, across South Africa. Yeah. So, for example, this deal is very nice because it goes to KZN, importantly. It goes to the Eastern Cape. So that our funds is not only concentrated in the general metropoles, but it's actually in the outskirts. So again, geographic diversification, project diversification, and impact across. Yeah. So it's a nice balance of risk plus impact, and then the returns that come. So our investors like that because they want to see that sort of, again, diversification across the country. And I think we're always very cognizant of what our investor wants and needs are, but in also taking risk into account. And this is a very nice deal because it goes across. Yeah.
Thank you, Conway, and thank you, Michelle, and thanks, Luzuko. And thank you all for joining us today. We hope you have a great day further.